In this video, I'm going to explain you everything you need to know about crypto investing. That means if you have a good income and are making 6 figures per year, but your money is sitting on the sidelines, earning 1 to 2% in a bank or having your money in a stock portfolio, inflation is eating at your wealth at a much greater percentage than whatever you receive as a yield at a bank. So you're actually getting poorer every year your money is sitting on the sidelines. And if you've looked at crypto as the potential solution, but were completely overwhelmed because of all the noise, the hype, and the which coin should I buy paralysis, you're exactly in the right place. 4 years ago, I was in your shoes. I was a busy corporate professional making a decent income, but watching my money grow very slowly through traditional investments. I knew crypto was the answer. Come on, we've all heard the stories about crypto millionaires. But every time I tried to actually learn it and invest properly, I hit a wall. Twitter gurus shilling garbage coins. We all know the YouTube bros screaming buy now when in fact the market is bearish, and Discord groups full of noise but no real substance. I felt stupid, like I was the one missing something so obvious in crypto investing that everyone else understood. I seemed to be the only one who couldn't get it right. So I did what most smart successful people do. I avoided it and stayed on the sidelines, earning my 5 to 7% on my money through traditional investments while watching the biggest wealth transfer from the sidelines. But then I realized something. The people making life-changing money in crypto weren't smarter than me. They just had a system, a framework, a strategy that cut through the noise. So I started investing blindly, but at least I started. So I spent the next 4 years building that system. I made every mistake in the book and lost thousands of dollars learning the investing process the hard way. But through hard work and building a proven system over the last 4 years, my small initial 5-figure investment turned into a substantial 6-figure portfolio that generates passive income while I travel the world. So in the next hour, I'm giving you the exact masterclass that turns crypto from overwhelming chaos into a structured wealth building system. By the end, you'll know how to build a crypto portfolio even if you have zero time to watch the charts and learn about crypto, the low risk strategy for conservative investors who want crypto exposure without sleepless nights or massive volatility, as well as how to generate 10% plus passive income on your stable coins, which is a much safer option than altcoins and also yields a tremendously better return than any bank in the world does. And finally, the exact framework I use to take profits during this bull run, so you don't have to write everything back to zero. So here's what we're going to do. Grab a pen, grab a notebook, and be ready to start taking notes. If you find this crypto masterclass valuable, please hit the subscribe button. So with that said, let's dive into the complete crypto investing masterclass. So first of all, we have to ask ourselves, why crypto as the investing vehicle and why you need to take action now. So this is a page of the Bureau of Engraving and Printing of the United States of America, and this shows all the banknotes that were printed in a single month, specifically April of 2025. And this amounted to around about $10 billion, which equates to $200,000 per minute, which is a massive amount of printing. This should just show that the United States dollars that you hold in your bank are constantly eroded when it comes to their purchasing power because more and more money is printed. And while this exact table is just a proxy for the total money that is generated, as the printing only makes up a small fraction of the total money added to circulation because the majority happens just electronically through bank ledgers. It's an important reminder for you as an investor to know that you have to acquire assets and generate above market yields to protect your wealth against inflation and actually grow your purchasing power. This is an important chart which shows the buying power of $1 over time, specifically since 1971, which was the end of the US gold standard and the beginning of fiat currency for the US dollar until today, 2025. And overall, the value has dropped by 87%, which is just massive. So imagine if you held your dollars since 1971 until today, you would just have a fraction of the purchasing power you had back then. So it's important to keep that in mind throughout your investing journey and frankly throughout your life. Unfortunately, printing and government spending isn't going away. This is the current chart for the US deficit, where we compare the revenue generated through taxes and other means and the spending that is required to run the government, to run the military, etc. We can see a deficit of 1.83 trillion, which in the end will just lead to higher debt and more money printed, which in the end erodes your purchasing power and your wealth that you hold in US dollars or frankly any other fiat currency in the world, whether it's euro, pound, Aussie dollar, New Zealand dollar, Canadian dollar, Swiss francs. They all face similar issues as the US dollar. Whenever again, spending is higher than revenue for governments, they need to issue more debt, which in the end requires them to pay more interest because they have to finance the debt. And in the end, we might see a scenario where central banks cannot operate without political interests because financing of debt is just so expensive. Currently, the US has to spend around $1 trillion to finance their debt, which is above 30 trillion, which in the end means around 1/7 of the total spending is just allocated to pay interest on the debt, which is crazy, right? That's 15%. So keep that in mind. Now let's jump back to the cryptocurrency as the vehicle. So now we've understood that as investors, you have to acquire assets and generate yield on your assets, because just by holding fiat currency, whether it's dollar, euro, or whatever currency, you will lose purchasing power over time. Here comes cryptocurrency into the picture, because cryptocurrency is a newly emerging asset class compared to all the other major asset classes that we have. And while it has grown a lot in recent years, and Bitcoin is already at around $100,000 price point per Bitcoin, it is still very small compared to the market cap of other assets. We look at gold, the S&P 500, or even the US residential real estate market, cryptocurrency still makes up only a tiny fraction in comparison to these larger asset classes. And cryptocurrency is now close to reaching $4 trillion in market cap, but again, that's nothing even compared to gold, which sits at around 25 trillion market cap. So the revolution in the digital economy is ongoing, but current investors, especially institutional investors who are looking to deploy serious capital in the space, are still early adopters, which is a good sign. So for all the people out there who are asking, is it too late to invest into cryptocurrency or into Bitcoin because the price point is already at $100,000? It's a definitive no, because in the grand scheme of things, we're still early. Again, the market cap is still less than 20% that of gold and much less than 10% of the S&P 500. So there's still a lot of room for growth. And historically, cryptocurrencies have proven to be an exceptional investment vehicle. If we look over the past 8 years, we have seen that Bitcoin and Ethereum have massively outperformed any other asset class, whether it is the S&P 500, gold price, MSCI World, or any kind of bonds. And you can see that the cumulative investing return was very, very extreme. And we can see a $10,000 investment in 2017 is now worth around $250,000 in Bitcoin and Ethereum, which is massive. And on average, Bitcoin has had around about 50% year-over-year return, with of course huge drawdowns, but also many years with exceptional returns. So Bitcoin has really outperformed everything, even in comparison to Ethereum, which stands at around 30% of annual growth and annual return, which is still tremendously good if compared to any other asset class. And now you might be wondering, all right, this is because, back then Bitcoin was so small, the market cap was so small. Of course, the investment now is worth a lot. Now let's think about what has happened if you have invested at the worst possible time, which would have been in 2022, right at the market peak when Bitcoin and Ethereum had its highs and then dropped like flies, minus 50, minus 60, minus 70% from the all-time highs. And you can see still you would have outperformed because Bitcoin still returned a tremendous return, and a $10,000 investment in 2022 at the worst possible time is now worth close to $40,000, which is a 400% return over the span of just a couple years, which is frankly fantastic. And the same with Ethereum. Due to the recent run and price action, it also showed a positive return, even slightly higher than gold. So that just shows that even at the worst possible time, you would have still yielded a tremendous return in cryptocurrencies. And that's why it's so lucrative to invest in them, because industry growth rate in crypto is just so much higher than any other asset class out there. And that's why it's extremely lucrative to invest in crypto if you know how, as well as have a long-term perspective on the market. All right, so after we have understood why crypto and why you as an investor need to take action now, let's talk about how to get started with cryptocurrencies. This here is the process of how to acquire cryptocurrencies. So first of all, you have fiat money, whether it's dollars, euros, CAD, Swiss, pounds, doesn't matter. And the ideal way of how to buy cryptocurrencies is first to transfer the money into a stable coin, which would be either USDC, USDE, USDT, or EuroC, or the digital version of Mexican peso. So it can be any stable coin. For this first part of the process, we have to open an account, send the money, and then swap the money, swap fiat specifically into the stable coin. And then in a second step only, you have to transfer the stable coin into a crypto coin. And with crypto coin, we specifically mean, Bitcoin, Ethereum, Solana, any other meme coin, you name it. For this second part of the process, you also have 3 steps, which is you have to open an account, you have to send and swap money. This process is extremely important in order to save transaction fees because they can really eat into your crypto portfolio performance. That's why this extra step of going from the fiat money into the stable coin and then only into crypto coins is really necessary, because otherwise, if you skip the stable coin transfer and directly buy the crypto coin on a centralized exchange, we'll come to that later in the video, this will eat into your fees significantly. I can guarantee you that, and I'll prove it to you. And let's first talk about this first step, the open, send, and swap of a centralized exchange where you can deposit fiat money and then transfer it into a crypto coin directly or into a stable coin first, which I recommend. And a centralized exchange basically is just a digital trading platform that acts as an intermediary for cryptocurrency buying and selling. It's just like a simple stock exchange, just for crypto. And 2 great examples for this are Coinbase and Binance. They both require a KYC, which generally is a good thing. This just means the broker has to know his or her customers, and that is generally a step to legitimize the centralized exchange, but as well as the user who deposits funds to the exchange. So Coinbase and Binance, they're respectively some of the largest centralized exchanges in the world. Coinbase, on the one hand, is a public company, so it's publicly traded on a New York Stock Exchange and just has that additional scrutiny from the SEC, whereas Binance doesn't have that because Binance is a private company. However, by volume, Binance is even bigger than Coinbase when it comes to spot and derivative trading volume for cryptocurrencies. Generally, both companies are global. They only have certain exceptions in certain regions, especially in the Middle East, for some of these centralized exchanges. If you are from some of the Middle Eastern countries or some of the other countries that are restricted by both Coinbase and Binance, there are plenty of other options, though not as safe and secure as these 2 in my opinion, but still also decent options. In my opinion, it's just very important to stay away from non-regulated centralized exchanges, which also do not require you to upload any form of identification, being within the KYC limits. And that is just really important because if you send money to some centralized exchange, which is located, in the Bahamas, for example, FTX was a great example for that, which went bust in 2022, or in any other tax haven or, regulatory haven, then you run the risk of losing your funds completely because you might just deposit money to a scam. And there are many centralized exchanges out there with different degrees of verifiability and a level of scrutiny, in my opinion. Just know that generally you should stay away from these non-regulated ones. I, again, recommend, some of the biggest ones, Coinbase and Binance, as they're just the most secure. And now let's quickly talk about why you should never buy crypto coins on a centralized exchange. I quickly touched on that earlier, and that is the transaction fees. Because if you buy on a centralized exchange versus a decentralized exchange, you can see in this literal graphical example how much of $1,000 spent for buying a crypto coin actually goes to the exchange via fees. And on a centralized exchange, you can see it's quite a lot compared to decentralized exchanges. While for $1,000, it might not seem that much, but if you are a serious investor looking to deploy more capital, in the realm of 50 to 100,000, if not more, then you definitely need to listen to this very closely. Because on Coinbase, for example, if you want to buy Bitcoin for 1,000 euros, actually only 961 actually go towards buying Bitcoin. And this 961, also 1% of it is actually going to spreads. Spread is basically the difference between the buy and the sell price of an asset. But as Bitcoin is such a frequently and highly traded cryptocurrency, the spread effectively is 0 or very close to 0. So this 1% spread is definitely inflated by Coinbase. So out of the 961, only 99% actually go towards buying Bitcoin. And then you have the additional Coinbase fee, which in total is around 47 euros of fees, which is crazy, because if you compare it to a decentralized exchange, you can see that there's just a 0.1% fee and a spread of 0.1%. So 1/10 of the spread versus Coinbase, and just around 1/30th of the fee versus Coinbase. And that is just crazy, because in the end, by buying on a decentralized exchange for 1,000 euros, you get 0.005 Bitcoin more per 1,000 euros, which is worth 47 euros. So if you are a serious investor looking to invest 100,000 euros, you actually save up to 4,700 euros by doing the previously mentioned step of buying stablecoins on a centralized exchange and then swapping these stablecoins on a decentralized exchange to the actual crypto coin that you want to buy. And that's exactly what I did here in the right example, taking the stablecoin EURC, which is pegged 1-to-1 to euro, and converting this fully into Bitcoin. And again, I get a lot more Bitcoin, which is just very important to understand, right? It's around 5% in fees that you lose on a centralized exchange. And that is just stupid, because if you buy 100K worth of crypto assets, you immediately lose around 4,700 euros, which is a lot of money. Keep that in mind. This might be the most important tip you'll ever see when it comes to, how to get started in crypto, because this really saves you a lot of money. This was basically now the first step of opening a centralized exchange account. Then of course you have to deposit the money, and we then quickly saw the swapping and how many fees we can potentially avoid by going the route via a stablecoin on the centralized exchange, and then on the decentralized exchange only swapping to a crypto coin. And now let's talk about the second part of the equation, which is opening a decentralized wallet, sending the money, and then swapping into a crypto coin. And that all happens on a decentralized exchange. So a decentralized exchange is simply a peer-to-peer platform that facilitates direct trading of digital assets or cryptocurrencies between users without a centralized intermediary. And decentralized exchanges are also called DEXs, and they operate on a blockchain, and you keep control of your keys and your assets. You just swap the money on that exchange. This here is a simple overview of how a decentralized exchange works. Basically, you have a pool of an asset, of an exchange asset, for example, Bitcoin to Ethereum or Bitcoin to USDC. And these pools are hosted on decentralized exchanges like PancakeSwap, Meteora, Uniswap, Radium, you name it, there are a lot of them. And actually, individual users, here you can see the three on the left here marked for as an example, they deposit money into these pools on the decentralized exchanges, and with that supply liquidity, so users like you and me can actually swap the coins, because liquidity is provided by individual users who in the end get a portion of the fees, and the other portion of the fees go to the decentralized exchanges. And there's one hack here, which is also very important, is that you don't have to scan all of these decentralized exchanges for the best swapping rate. You can actually just go to an aggregator, which is either Jupiter for the Solana blockchain or Jumper for basically all other blockchains, and they will give you the best quote across all decentralized exchanges for the same asset. So if you want to swap, for example, USDC to Bitcoin, you can just go to Jumper on any blockchain, and Jumper will give you the best rate across all decentralized exchanges with the lowest fees, where you receive the most amount of Bitcoin for your USDC. So that is an important hack as well to consider when swapping on the blockchain. Now let's quickly talk about the true ownership of assets. And this is truly only possible in crypto if you have a decentralized wallet. And you need that in order to swap crypto the efficient way with, just 1/10 or 1/20th of the fees compared to a centralized exchange. Decentralized wallet means you have no custodial risk. So no bank actually holds your money and can do illegitimate things with it. No, actually the money is with your device, either physical or digital wallet, and no one can access it. And there's a saying in the crypto world, which is your keys, your crypto. And that's a very important saying. And always remember that. We've all seen the FTX drama back in 2022 when one of the biggest centralized exchanges went bust, and all the people who had the majority of their funds on the centralized exchange lost it almost completely. And that is something that you should definitely avoid. We also have a high degree of security because some physical wallets can, for example, not be easily hacked. But the high degree of security also applies to digital wallets. There's just a high degree of security. Furthermore, let's quickly talk about the address and the keys, which these words you have to know whenever you talk about decentralized wallets and the whole decentralized exchange on the blockchain. And first of all, every wallet, so your decentralized wallet, whether it's physical or digital, we'll come to that in a second, they all have a public crypto address. This is an encrypted information and it's just a numerical code. For example, here is one that I linked, and this would be an example for a decentralized wallet on the Ethereum blockchain, to be specific. That is how you can interact with the blockchain, and this will be visible on transactions. So this is your crypto address. People will not know that this address is connected to you, but this is the public address that's visible on transaction logs. Then you have the private seed phrase, and this is arguably the most important data set that you need to know for your decentralized wallet. And this is predetermined, and this is a set of 12 to 24 random English words that you have to physically write down in order to back up your wallet. Because you see, with decentralized wallets, there's no bank you can call or you can contact customer service. Hey, please reset my password. I forgot it, or I lost the device or whatever. This is the only way to back up your crypto if you lose access. Because again, there's no centralized entity that can actually provide you this information with. Because remember, we have no custodial risk, which is good. But on the other hand, the responsibility for access and maintenance is with you when it comes to the decentralized wallets. So remember this. This is very important to write down and document. And lastly, there's also a wallet password. You choose the password, and this protects the access and the private key needed to sign transactions. So if you have heard of these three terms, you are 95% further than most crypto investors. And this will help you dramatically in your crypto journey, especially if you're looking to deploy larger capital and take advantage of the investing opportunity that crypto offers. Because then my high recommendation is to use decentralized wallets and not only save transaction fees, but also ensure that you own the crypto that you actually purchased and that no other entity has access to that. Now let's talk about the wallets specifically. And first of all, let's talk about cold storage wallets. This is a fancy name for physical wallets that you can buy online, and they get shipped directly to your home. And after setup, you can actually deposit money into these wallets and use them on the blockchain and on decentralized exchanges. And on the other hand, we have hot storage wallets. These are digital wallets that you can use on the blockchain to transact with different decentralized finance protocols, for example, and earn income with your crypto. What this specifically means is that you can deposit your money in decentralized finance protocols and actually earn a yield on that. And for that, you need the hot storage wallets. And cold storage wallets, there are two very reputable companies. It's Ledger Company and Trezor. They're both really good and again, very reputable, and they are trusted by millions of crypto users worldwide. In my opinion, I just prefer Trezor because Trezor has an open source code, so you can always verify that there's not some backdoor that they can access the funds. While of course Ledger is also a very reputable company and millions of people use it without a problem. In the end, their code is secretive and you don't know if there is some backdoor installed in the software of the wallet that can harm you. But generally, both are really good. However, I personally prefer the Trezor. And on the hot storage wallets, there are a couple very good examples. For example, the Fox, which is MetaMask. You have Phantom Wallet, you have Coinbase Wallet, you have Binance Wallet, and you have a bunch of other wallets that you can connect to via your web browser and can in the end access the world that cryptocurrency offers with all the decentralized finance protocols, with any kind of, DEXs or decentralized exchanges. So that is very, very good to have as well. And as you can see, both of these wallets have a use case, right? The cold storage wallet is just very secure because it's not easily hackable. It's not connected to the internet. And on the other hand, the hot storage wallet actually enables all the benefits that cryptocurrency offers when it comes to high yield generation for assets, not only stable coins, but also crypto coins, as well as significantly lower transaction fees than centralized exchanges. So both types of wallets have great aspects and advantages for you as an investor. However, here comes the next tip, and this many people don't actually know. The key is to combine both wallets together, and this is extremely powerful because you can buy a physical wallet, get it shipped to your home, deposit funds on this physical wallet, and then actually connect the physical wallet to a hot storage wallet such as MetaMask. And with that, you have the best of both worlds. You have the high security and the option to participate in very lucrative decentralized finance protocols as well as the decentralized exchanges. The best thing is whenever you do a transaction, whenever, for example, you send money from here to there, or you want to swap a coin, that you have to verify the transaction twice. So on the one hand, you have to verify it in the digital wallet, so the hot storage wallet, and then you have to physically click a button on the cold storage wallet in your home. And this acts basically like a two-factor authentication for like a social media or a bank account, because you have to authorize a transaction on two separate devices. And this is just the ultimate form of security, and something that I highly advise my personal clients in our crypto masterclass Beyond the Market. I highly advise them to use both and combine them for optimal security. And now, having understood how to get started in the crypto world, it's a no-brainer that the first asset we are going to talk about is Bitcoin, which is the digital gold. I think everyone and their mother have heard of Bitcoin already, because it's been in all kind of news outlets, whether it's print, whether it's digital, whether it's TV. You know, we all heard about Bitcoin. And now let's actually break it down what it is, so you have a better understanding and can brag, to your colleagues that you know what Bitcoin is and what the use case is, etc. So let's break it down. Basically, on the Bitcoin blockchain, there can be a standard transaction. For example, let's look at this example transaction, which is one Bitcoin is sent from user A to user B, and in exchange, user B sends user A 100,000 USDC. Depending on the time that you see this might seem like a lot, or might seem like a very cheap price for a Bitcoin. And what happens now is that through Bitcoin mining, which is basically independent validators, they, through mathematical code, they validate this digital contract on the blockchain and basically ensure that the whole network now acknowledges that person A has 100,000 USDC and person B has that one Bitcoin. And this is the key difference when it comes to cryptocurrencies in comparison to traditional finance, because in traditional finance, this transaction also happens, but then this is recorded on a bank ledger, which is maintained by people or by machines which are connected to a specific company. However, in cryptocurrencies, specifically here in this Bitcoin example, this is validated independently, and the whole network basically acknowledges that this transaction happened. And in the ledger, if you want to call it like that, in the ledger of the Bitcoin blockchain, it's now recorded as a transaction and validated. And this is what Bitcoin mining centers do. They actually solve complex mathematical problems with that, verify the transactions, and in the end get a reward for this mining. We're going to talk about that in a second. Once a transaction is validated, it enters a new block, a block which is not yet added to the blockchain. And once a multitude of transactions are validated, this new block is finished and actually added to the blockchain in conjunction with all the information that all the previous blocks of the blockchain have. So basically, always the latest block in this chain of blocks, or the blockchain, has all the information stored from all the other blocks, which are already secured and not retrospectively changeable. And that's, in a very, very simplified way, how the Bitcoin network works and what the fundamental difference is in cryptocurrencies versus traditional finance. And these miners, for validating transactions, they get a reward. And this reward is cut in half every 4 years. So basically 2009, they still received 50 Bitcoin for every completed block. And by 2024, it's only 3.125 Bitcoin as the reward for solving these complex mathematical problems that require a lot of computing power. And again, in the end, they receive, the current stance of 3.125 Bitcoin. And through this halving effect, the issuance schedule and the actual inflation rate of Bitcoin is converging to zero eventually. Currently, right, we're in the very, very low single-digit percentage inflation rate for Bitcoin, as we can see, and the Bitcoin supply is slowly but surely curving towards that 21 million total supply, which is the maximum supply of Bitcoin that will ever exist in the world. So now that you've understood this more complex part of Bitcoin, what does this actually mean for the Bitcoin price? Because that's what you care about as an investor. And through this deflationary issuance schedule that Bitcoin has, there's actually a supply shift. When you think about a traditional supply and demand curve which regulates price in a macroeconomic environment, we can say that through this deflationary issuance schedule of Bitcoin, the supply is actually shifted upwards because supply is reduced, right? While there's still an increase in supply, the increase rate is going down. And that's why we can say that the regular supply is actually shifted upwards because it's reduced. And in the end, a higher price is found with constant demand. And this is something that we can actually see on the crypto chart. So now it gets really interesting. With these price increases that we can see here on a theoretical level, we also have that on a practical level. So let's look at this chart, and these black lines, these black vertical lines, they always mark the Bitcoin halving event, which happens roughly every 4 years after 210,000 blocks are created and completed. And this means afterwards, the Bitcoin issuance is cut in half. And what we can see is always after this specific event, roughly for around 1.5 years, it really depends on the cycle, we have a massive Bitcoin rally and price runs significantly. And that's what we can see after the 2012 rally, after the 2016 halving, after the 2020 halving, as well as after the 2024 halving. We can see the exact same thing. Bitcoin always surges in price following the halving because it's a simple macroeconomic shift in supply, which in the end increases price with constant demand. And that's really cool, in my opinion, to see this play out so clearly on the Bitcoin charts. Bitcoin also has recently had its ETF record inflows, and since 2024 we actually have ETFs in place for Bitcoin. Since then we have seen the ETF approval for Ethereum as well as Solana, so we're really progressing on that front because ETFs are a great way for the average investor to invest into crypto. Sure, it will carry high fees, but it's very convenient, right? Because you can just do that with your normal stockbroker and you don't have to handle all these things with a decentralized wallet, etc., right? So it's convenient. Of course you pay for it in the transaction fees and the management fees, but overall this is great for the Bitcoin price and for the space, right? Because it's institutionalized, right? Really, pension funds and massive money managers are now accessing this crypto market, and this means only one thing for prices: they go up, which is really good for us as crypto investors. And we can see the total assets under management are already exceeding around 150 billion just for Bitcoin alone. And one other aspect that we have to cover are the total inflows of ETFs when it comes to the growth rate, as well as other major institutional entities who started accumulating Bitcoin. And first of all, governments actually hold a lot of Bitcoin, around 500,000, right? Remember, the total supply is only 21 million. So 500,000 is a decent chunk of change when it comes to the total Bitcoin supply. So governments hold a lot, mainly accumulated through seizing criminal activity in the end. As we can see, they're not buying at this current stage in time. However, many countries have actually started to put legislation in place to not easily be able to sell their Bitcoin, or have gone further, like for example El Salvador, and actually invest public money into Bitcoin. When we look at native crypto institutions like exchanges, Coinbase, Binance, whatever, we can also see that they hold a significant amount of Bitcoin. However, they're not really buying anything since if we look at the time horizon from 2024 until 2025. However, now it gets interesting. Now we look at public companies, and they actually hold over 1 million Bitcoin. So that's more than 5% of the total Bitcoin supply, which is massive. And we can see there's a very strong growth rate. And that's the main level of institutionalization we have seen in the crypto space in the last 1 to 2 years, where many companies, for example, MicroStrategy, SpaceX, Tesla, and many other companies have either started accepting payments in cryptocurrencies or actually have invested themselves in the crypto coins, which is massive to see and very positive for us as investors. And last but not least, we have the ETF funds and inflows, and we can see they also have a lot of Bitcoin already, over 1.4 million of them. However, when we look at the growth rate, actually public companies acquire Bitcoin at a much more aggressive rate rather than ETFs and funds. So that is important to keep at the back of your mind whenever you see changing charts on specifically these four. This can mean either, an imminent run or an imminent pullback or crash. For example, if we see, public companies and ETFs stopping their investments into Bitcoin and other crypto assets, that would not be positive. So important to keep an eye on them. As part of the fourth action step here in our crypto masterclass, let's talk about critical investing lessons. And there are a tremendous amount, and I can only cover a few here, which arguably are some of the more important ones. However, there are many more that I'm covering with my clients investments in one-to-one calls or within Beyond the Market, our community for high-level investors. But in here, we're going to talk about some of the critical ones. First of all, it's important to understand why current investors fail. And this gives you a great handbook almost of what you as an investor should not do in order to succeed in the crypto investing markets. And first of all, it's not willing to cut a loss. And this is something psychological. And there have been many studies to test their behavior for either winning $1,000 or losing $1,000. And actually the emotional reaction is much greater for losing $1,000 than for gaining $1,000. But theoretically, it's both the same, right? It has the same magnitude of impact on your life, but the emotions play a different role here. And many people are unwilling to cut the loss and actually lock it in because they think, it's going to return and it's going to come up. And, there's this catalyst and this catalyst, but that is often not the case. It's most often a great idea to cut a loss, especially for altcoins. Missing technical knowledge is also very important because the crypto market also moves based on technical analysis. So in bull markets, bear markets, support, resistance, trends, ranges. So that is also important to understand in what environment are we currently in the crypto investing markets. It's oftentimes that new investors feel overwhelmed because there's so much noise and people say, you have to buy this coin, you have to buy that coin, you have to buy this, you have to do this. And they're feeling just overwhelmed because actually people online make it very difficult to invest in crypto because they will come up with some sort of altcoin that is primed to do a 10x, 100x, whatever. And I can guarantee you 99% of these cases are scams, or the people who actually promote them have invested themselves and want you to be their exit liquidity in the end. So be careful whenever someone is shilling a weird coin, because trust me, I have been there. I've done that myself, and I do not want you to make that mistake because you will start investing into shit you don't understand. And that's not how you as a serious investor want to act in the crypto markets, because it will be punished heavily. The next point goes hand in hand, investing blindly, right? Make sure you understand just from a fundamental level, at least, why you're investing. And this will also give you the emotional conviction to hold on to, for example, your Bitcoin if there is a correction in a bull market or something. So if you have strong conviction, this often can help weather a storm. I've talked about this already briefly, the volatility. Volatility is a key part, an inherent part in smaller asset classes like cryptocurrency. While having exceeded the $3 trillion mark, every individual coin is still rather small considering other asset classes. So volatility can be tremendous. There can be days where a specific coin drops 15, 20%. I have seen other coins, rally up to 50% in one single day. So volatility is just inherent in crypto, and all you have to do as an investor is manage it with strong rules and not based on emotions. And then over time, you accustom to the volatility. It's important also to keep your portfolio simple. We're going to cover that in a second as well, but you should not rotate positions too often, from this altcoin to the next coin to the next coin. This usually doesn't end well and is also not wise from a tax perspective. And chasing hype is extremely important, because if there is hype about a coin, about something, it's usually too late or not the right time to invest, right? If everyone is talking, for example, just a month ago, everyone was talking about Ethereum. Ethereum is the best coin, especially in the wake of the Genius Act. But people who invested after the hype, Ethereum already did a 300% run from like $1,500 to $4,500. So what makes you think that when you buy at $4,500 that it's actually going to go higher? So you have to invest before the hype or after the hype cools down and the coin still looks good, because during the hype you will get easily burned. And last but not least, don't listen to the wrong people, and that's with everything in life, but with crypto especially. In your portfolio, you should always think about the issue between concentration and diversification. You want to pay attention to both, but do not lean on either side too aggressively. And what I mean with that is, on the one hand, you should not hold too many coins. In my opinion, the absolute maximum you should hold are 10 coins. Better actually to have 5 or less, because this ensures you understand each coin you invest in, and you can actually manage the emotions, and you can have a look every once in a while how the price action is doing of that coin. So it's better to be concentrated and not hold any more than 10 coins under any circumstance. Ideally, cut it down to 5. And the core of your portfolio should be focused around the best risk-adjusted return. And during most market stages, this will be Bitcoin, because Bitcoin has the least amount of risks and often performs the best. We saw earlier, Bitcoin actually has a way better cumulative return over the past 10 years, in conjunction with Bitcoin being the lower risk asset because it's the most institutionalized. So why would you invest in Ethereum if Bitcoin has a better return and has less risk? So it's quite obvious. And that's why also Bitcoin actually performs the best most of the time. And this could be a core example of your portfolio. And what's important to know is the portfolio breakdown changes depending on the market conditions. And there is a detailed portfolio theory from my side within my proprietary Core Vault method, where we talk about specific portfolio allocations depending on risk parameters for you personally as an investor, as well as the current market conditions. And depending on those two factors, we will adjust every portion of our portfolio, whether it's the Bitcoin position, the altcoin positions, or stable coins. And with that, you have the best chance of outperforming the market. And now let's talk specifically about outperforming Bitcoin, because we have heard that Bitcoin is the least risky asset. So if Bitcoin performs better than an altcoin, why would you want to hold the altcoin? Altcoin carries higher risk, and if the return is lower, why not hold Bitcoin? So it's important to monitor the Bitcoin dominance always. And there is a specific chart actually on TradingView, which we can see on the bottom left, which is the Bitcoin dominance in percent. And this indicates the Bitcoin price performance versus the cumulative sum of all other altcoins, excluding stablecoins, of course. And whenever the Bitcoin dominance rises, you want to hold more Bitcoin and or stablecoins potentially, because this signals a more risk-off environment. This is oftentimes the case during a bear market or during the beginning of a bull market. And towards the later stages of the bull market, when Bitcoin dominance tentatively drops often, or towards the end of a bull market when oftentimes the Bitcoin dominance drops because euphoria and risk-taking enters the market, then it's usually a good time to invest some of your Bitcoin position or stable coins into altcoins that actually outperform Bitcoin. However, this is usually just a seasonal outperformance and oftentimes not a long-term guarantee. As an investor, you have multiple options, of course, how to approach the crypto markets. And a lot of the times it has to do with your psychology of how you view the market and how invested you want to be when it comes not only to the monetary side, but also due to the time side and what returns you are searching for with your portfolio. Because very simply, you can just DCA into the market, as we can see here, and buy regularly Bitcoin, especially no matter the market condition. And this is something I can recommend, especially for Bitcoin, maybe for, Ethereum and Solana, the two major altcoins, BNB if you want. But these coins have a very high risk because they can crash, 60, 70, 80% from the highs. And most investors don't want to take this volatility. And this oftentimes is not the best risk-adjusted return for your portfolio. So the DCA strategy, I personally only use for Bitcoin because this is a great long-term asset where I have 100%, 1,000% confidence that, by 2030, Bitcoin will be much higher in price than it is today. With the increasing level of institutionalization and market cap, the swings in volatility will drop. So the DCA strategy is a great option for Bitcoin. However, you can, of course, enhance your portfolio return if you time it right and adjust your portfolio based on the current market conditions. When it comes to risk management, it's important to have clear entry and exit rules for your portfolio. And this is especially relevant for altcoins because altcoins carry a much higher volatility, as I said. So for the risk management from the entry perspective, you have multiple options. You can DCA into a position either regularly, so every week, every month, no matter what the market does, or option two, you can dollar cost average during dips. So whenever the market corrects slightly, you can add to your position, and with that, oftentimes get the best average entry price for your investment. Option two is you enter a position once an altcoin is outperforming Bitcoin. And this is the more technical side of investing. So if you want to max out the returns for your portfolio and really have time to monitor the charts, then this is a great option because altcoins have a tremendous return potential, but only during seasonal outperformance. And that is something that we are covering in Beyond the Market in our weekly webinars, where I, with my team together, we're scanning the market and we're looking for altcoins that are currently outperforming Bitcoin and will notify the investors in the community accordingly whenever an altcoin is outperforming Bitcoin, such as recently in September 2025, Solana looked very promising and actually gained up to 20% relative to Bitcoin in just a short period of 2 weeks. So that was a really nice catch. But yeah, these are your entry possibilities. And option number three is to enter a position at support or during a breakout. And this is also more advanced because it requires some basic technical knowledge, but generally also not a bad idea. And this can look something like this. For example, entering a position at support, right? We can see where the green arrow is. This horizontal line has acted as support multiple times before. And so there's a high likelihood that it will act as support again. And in the end, the coin rallied absolutely spectacularly. This was MNT, by the way, so mantle. It was a really nice position. And this is something you could have caught as a more advanced investor once you had seen this pattern play out. Or, something like this, where this is actually a meme coin. And there was a clear diagonal trend line where price bounced off of multiple times and then it broke once very confidently. And this would have been a great time to enter a position in there because it looked like definitely a seasonal outperformance and in the end returned an exceptional amount. But more important almost is the exit strategy. So as I said before, you as an investor, you need to have a mindset shift and you have to decide which assets you're going to hold long term, no matter what the market does, if you want to hold any long term, and the rest you should only hold during seasonal outperformance versus Bitcoin. And secondly, the next step is to have a stop loss. So a stop loss is an automated liquidation for your position, especially for altcoin positions. And this is a very unnatural way of investing for classic investors who, have invested in the stock market, for example, in the S&P 500, where you just buy and you don't do anything, and then in at least a couple of years it will be higher than where your entry was. However, in crypto it works a bit different because crypto is so volatile. That's why I personally use always a stop loss for my altcoin positions, because it's better to realize a small loss and re-enter at a better price instead of holding a huge drawdown. And this is a great example that we have here, which is a personal coin that I invested in. It's Aero. This is the main decentralized exchange on the base blockchain. And I originally entered at support. I think this was roundabout at $1 and price rallied from there, but in the end came crashing down and dropped much further. Actually would have been, if I wouldn't have liquidated my position for a small loss, a 70% drawdown because it went down to 30 cents. And imagine this as an investor, if you have a sizable sum in this altcoin and it drops by 70%, imagine you might have sleepless nights. So it's better, in my opinion, to realize a small loss and wait when the market is shifting its structure and when we have bullish price action, as we have in this example on the right hand side, when actually there was a bullish breakout, a breakout of the previous high and the diagonal resistance, and the market sentiment turned bullish for Aero. And this would have been a fantastic position because you would have gotten an entry roundabout at 40 cents and the price rallied up to $1.20. So this would have been a 3x or 300% return depending on how you would have played it. But these are exactly the kinds of things which really enable your success and your edge in crypto investing, because simply buying and holding, especially for altcoins, is not a strategy. It is doomed to fail. I guarantee you that from my own personal experience. And now let's quickly talk about the global macro impact. There are 5 factors that influence crypto prices, and contrary to Twitter hype or paid articles online, it's not, the sentiment that actually drives price action. No, it's these 5 macro factors, and they will only become more important as crypto matures into a major asset class alongside gold, stocks, and real estate. And if you understand these 5, you have a tremendous edge over any other crypto investor. First, let's talk about monetary policy. Monetary policy is rather definitive and clear. It's the central bank interest rates. So whenever central bank interest rates go down, cost of borrowing goes down, people borrow more, they get more loans, and in the end, the global money supply rises. And this is the effect of lowering rates. On the other side, if you increase the rates, the global money supply will go down. And this is very important to understand, because if there's more money in the system, it will very likely flush into risk-on assets such as cryptocurrency. So lower rates, or the projection of lower rates, especially from main central banks like the Federal Reserve, are very positive for crypto, because this means that there's more money in the monetary system, which is likely going to spill over into the risk on assets. And this is currently, as of 2025, the expected Federal Reserve interest rate development over the coming years, and we can see it goes down. Currently, we are between 4 to 4.25 percentage points, and by 2026, the expectation is that we drop down to 2.75 to 3%. So this is a very bullish scenario that we currently have over the long term, because the federal interest rate is projected to go down, which in the end increases the money supply. And secondly, we have to look at quantitative easing and tightening by the Federal Reserve. This is a bit more stealthy because it's not that shiny news that you'll see everywhere in any kind of, economic journal, such as the interest rates. This you actually have to read the FOMC statements that the Federal Reserve always publishes on their website, and there you can see certain text and certain line of text which hints at quantitative easing or tightening. Here, for example, we have one sentence which basically says Federal Reserve is still executing quantitative tightening, meaning they pull money out of the system by reducing their security holdings. However, they're reducing the holdings to a lesser extent each month. So basically, in plain English, this means the QT of the Fed is slowly but surely coming to a halt. That's at least where we currently are in 2025. And this also reflects in the total balance sheet. This is also something that I can only highly recommend you keep on your TradingView watch list, which is the total balance sheet assets of the Federal Reserve, because this is a great indicator of the money supply going around and has a high correlation to the risk on assets such as cryptocurrencies. And we can see here the deterioration from the 2022 highs of the total balance sheet size is coming to a halt slowly. And now it really depends on what the Federal Reserve is doing next. But based on the projections and based on the reduction of the interest rates, it looks like we might see a reversal in the total balance sheet size of the Federal Reserve to the upside. Secondly, let's quickly talk about fiscal policy. Fiscal policy basically includes anything from government spending to taxation to any kind of legislation that has macroeconomic impacts. And we discussed that at the beginning, but basically, if governments keep spending money and having lower revenues than whatever they spend, there will be a deficit for which debt has to be issued and interest has to be paid in the end, which eventually will result in new money being printed. So as long as money value and fiat currency is devaluated by money printing, it's always good to own core assets such as cryptocurrencies. And that's what we can currently see also for the Federal Reserve. Again, the spending is not what we can see currently for the US government. The spending is higher than revenue. And what we can also see is that the percentage of debt comparatively to the GDP has increased dramatically for many countries. And the USA, which is again the leading economic nation of the world, which also has the main reserve currency, the US dollar, as their main currency, has now also a spot among the top countries in debt by their GDP, with up to 135% debt to GDP ratio. And that is really concerning and something to keep an eye out from the perspective of currency debasement. And what we can also see with the Trump administration in 2025 is that there is a big push towards more spending, such as the Big Beautiful Bill was passed in 2025, which among other things has tax cuts for tips and extensions for tax cuts that originally Republicans granted back in 2017, which were set to expire. So overall, this is a very favorable bill, because if you tax people less, people have more money to spend, and oftentimes this will end up in investments into the stock market as well as cryptocurrency in the end. So basically, bills which reduce taxes and increase government spending are generally positive for us investors in the cryptocurrency market, because they bring more money into the space. Next, we have to quickly talk about the role of the US dollar. The US dollar, again, is the world's reserve currency, so it's important for you as an investor to monitor. There is one chart on TradingView which is called the DXY, and we can see it here on the right hand side, and this tracks the strength of the US dollar against all other currencies. Basically, if the US dollar weakens, so this chart goes down, investors look for higher yield opportunities because the demand for US dollar goes down, which means investors are looking for other opportunities, and this generally means a bullish risk on sentiment. So investors are looking towards the stock market, towards crypto to deploy their money, because during times when the dollar is falling, oftentimes the government bond yields are not that great. So we recently had a bond yield spike up to 5%, and 5% risk-free sounds great, right? But 1.52% 30-year government bond is not enough for most investors when it comes to the return. So whenever interest rates are reduced, the US Treasury yields become less attractive, again, because the yield just goes down. And this oftentimes leads investors to invest more money into the crypto market. So it's also something you as an investor need to monitor. Again, in our weekly webinars, Inside Beyond the Market, our crypto masterclass and mastermind for high-level investors, we are going to cover the US dollar development also in our weekly webinars, because it's crucial to have a look on how the US dollar develops. Global liquidity is something that is very hard to wrap your mind around, but it's simple if you understand that basically all the previous factors, especially monetary and fiscal policy, have a great contribution to the global liquidity development. And what you can see over the long run, right, that US money supply in the stock market very much correlate and they go up together. And every one of you probably have heard the statement that over the long term, stock prices always go up. But why do they actually go up? And the reason is because global money supply increases constantly, so companies keep investing more money and keep generating more profits, which in the end boosts the valuation of the company, and the stock price consequently adjusts because the company is worth more. And that's why stock prices in the long run always go up. Of course, we talk about indexes. Individual companies go boom and bust all the time, but from a macro perspective, especially risk on assets thrive in market conditions with abundant liquidity. And these risk on assets are crypto as well as the stock market, and lately very much the tech stocks, Nasdaq, the AI stocks, Nvidia, Palantir, you name it. So in liquidity abundant conditions, investors are looking for higher asset returns, and low risk assets like US treasuries just don't offer the yields that investors seek. That is just the reality that we face as investors. And if you understand these principles, you can maximize this in your personal investing journey. And this is a chart which shows the Bitcoin price here in black with the global money supply growth. And what we can see is that there is a strong correlation to the global money supply, or also called M2 growth rate. So to the first derivative of the growth. So meaning the rate of growth. Whenever the rate of growth expands, usually crypto prices soar. And whenever the rate of growth declines, it's when oftentimes you need to be cautious as investors. And what we can see here is also a chart that should be on your TradingView watch list, which is the M2 global money supply. And as we can see, as of 2025 Q4, it is at all-time highs. So it actually has surpassed the 2022 levels already. And last but not least, the things that influence the crypto prices in a macroeconomic perspective is crypto regulation. And in 2025, we have seen a bunch of laws being enacted. Most importantly, the Genius Act, which basically regulates stablecoins and makes them institutional investing grade. And that is something very positive for the space because it legitimizes stablecoins and in the end ensures that many more investors are attracted to the crypto markets because it becomes more and more institutional grade. Additionally, we have seen the US Clarity Act, which specifically looks at layer 1 blockchains. And we're going to talk about why that is so important, because now we have a clear definition of what a digital commodity is. Because as a crypto coin, you don't want to be seen as a security. You want to be seen as a digital commodity because you have completely different guardrails of your financial instruments. And that is very bullish here because there is a definition finally. And this in the end actually yields to more ETF approvals. If we look at the current list of ETF approvals for cryptocurrencies, we can see a lot of layer 1 blockchains, which are by the US Clarity Act defined as digital commodities. These ETFs are close to being approved, and there's actually no ETF in the pipeline which is not for a layer 1 blockchain, which is defined as a digital commodity within the Clarity Act. Just generally understand that regulation generally is good for the crypto space because it institutionalizes it further and ensures that big fund managers and hedge funds actually invest more into the crypto market, which in the end boosts prices and also increases the valuation of our personal investments. In the end, the Clarity Act specifically looks at layer 1 tokens, which in the end are more legitimatized. As a last point in the crypto investing masterclass, we have to talk about an action plan. You've probably heard the statement lately that knowledge isn't power anymore. Applied knowledge is power. So unless you actually do something and get into the crypto investing space, you wasted the entire hour of this masterclass because in the end, knowledge isn't power anymore. It's applied knowledge. So you actually have to do something. So let's look at a simple 7-day action plan to get you started as a crypto investor. And it's very simple. On day 1, you set up an exchange account on Coinbase, Kraken, or Binance, or any other centralized exchange that has a KYC requirement and is regulated. It's important. As well as order your physical wallet with Ledger or with Trezor. I have all the links down in the video description. Secondly, you enable the two-factor authentication and secure your account on the second day, and hopefully also receive your physical wallet by the second or third day. Then on the third day, you can make your first purchase, $100 in Bitcoin. If you only invest $100 or let's say $1,000 to Bitcoin, it's usually worth it to do it just directly through the centralized exchange because the total amount of fees are not that great. If you're a serious investor looking to invest more money, definitely consider the option via the decentralized exchange, because I guarantee you, you're going to save so much money because the fees do not only apply when you buy currencies, but smartly enough also when you sell. So you actually save double the fees when you go to the decentralized wallet and swap on a decentralized exchange. And that's exactly what we preach also within Beyond the Market, so that our clients actually get the best return on investment and do not lose like 5% immediately just due to fees. Then on day 4, you don't do anything and you just look at your portfolio if you want and get comfortable with fluctuations in the price. And on day 5, you set up an automated dollar cost average, either $50 or $100 weekly into Bitcoin. And I can almost guarantee it to you that in the next 5 years, you're going to see a tremendous percentage return on these small but consistent investments. And on day 6, you can research Ethereum and other altcoins if you're interested. And on day 7, I urge you to review this masterclass, look at the notes you actually took today, maybe replay some sections of this masterclass in order to get familiar and even a stronger knowledge in the cryptocurrency investing space. And this is a simple action plan that every one of you can do. And I really hope that you take action based on your knowledge, because only applied knowledge makes any difference in your life. And that's what we want. So 7 days to go from a complete beginner to an active investor. And that is something that is really, really important to me. It's simple and it has the potential to dramatically alter your life for the better if you take this seriously. Again, for me, this was the case 4 years ago and I learned so much. I have increased my returns tremendously through the crypto market beyond my imagination. I only want to pass this torch on to you and get you set up for the crypto investing market. If you made it this far in the cryptocurrency investing masterclass, you are by far 95% further ahead and smarter than the average crypto investor. And I hope you use this knowledge to your advantage to make a positive difference in your life. If you are a serious investor looking to deploy capital in the crypto markets with at least $50,000 in current portfolio size or investable capital, then click the link below if you're interested to work with me and my team directly to set up your crypto portfolio and monitor it constantly and adjust it based on market conditions to optimize your return. While this is a comprehensive lesson, there's so much more that we need to talk about when it comes to crypto investing. So I'm looking forward to hearing you via the link below. And if you've enjoyed this video, please leave a like because it helps the channel tremendously. I hope this made a positive difference in your life. With that said, cheers. See you in the next one.